Good morning, good afternoon, and good evening to all of our crypto fans across the world. You have your tres amigos, Senor Robert, Senor Carlos, and Senor Matt. Gentlemen, I was a little surprised today when we were doing the notes. I noticed that our man Carlos wasn't drinking Patriot water today, and that was a little surprising. I was a little shocked. I thought the man had a ritual in place.
Well, we're in between visits to Costco, so I mean I'm living my best. Like my wife and I had kids back in 2021 during the height of the pandemic. We did the stereotypical thing and we popped out to the burbs. We live in Greenwich, Connecticut now, and I used to do fine dining, and when I say fine dining, I mean dive bars in the East Village, quite regularly. And now I find myself on the weekends, taking children to children's museums, aquariums, and occasionally when I have time, going to Costco. So in the interim, I borrowed this from my father-in-law, which is a green state lager from the fine state of Vermont. It's good. It's no Patriot water.
The demographics, let's do drinkability instead.
Yeah,
that's hilarious. Yeah. Matt, what did you got over there? Something different? Green
bottle.
I
did a Costco run as well. It's got a youngling. I don't like it. This is the first one I've had. Maybe it's just a bit warm or something.
If you ever go to Philadelphia, never ever ever say you don't like youngling. You might get murdered.
I'll bear that in mind.
Yeah.
I don't know, man. I kind of like my beer at a nice temperature of room temperature. Something like 70, 75 degrees.
That's basically where
it's kind of like allows the aroma a little more to flourish and
nothing like that.
Yeah. For
me,
I
like warm beer, and I like a room that smells like an old pair of socks.
Isn't all beer kind of like that though? Really? Boys. I'm drinking tequila and soda today. It's 85 degrees outside. Putting on my summer jam right for happy hour.
I love it.
What do you say we dive into some topics today? We maybe talk a little bit macro, some stuff a little on chain around Ethereum, and then dive into some more interesting topics too. The more relevant to Deep Q, also some of the market making stuff that we've been seeing on chain. FOMC meeting minutes. I know we had talked about whether we thought the Fed was going to hike now in additional, especially given the banking fallout with some of these regional banks, and it didn't seem to make sense, right? But it looked like there's a lot more consensus around the Fed hiking an additional 25 basis points. Is that right?
For the hike we just had, you mean?
Yeah.
I mean, yeah, they all agreed to do it, but I think there are a few people that noted their concern about the credit market. And like you guys were talking about this last week, which it's a good podcast, by the way, with Yang On. I think the fact that they noted it explicitly in the minutes that it was a contentious point and some people were a bit anxious against it, means that they are seriously considering other things that may take a bit longer to filter down than just the kind of core CPI, PCE numbers that typically drive these decisions, and obviously NFPs. So, I mean, it was good to have that written in the papers. Obviously, it didn't change the outcome; they still hiked, and the numbers we kind of got this week for CPI again are not really looking a huge amount better. They're not materially lower, basically, especially core CPI is still massively driven by shelter. I know that personally. My rents went up, so I'm very bitter about it. But
did you threaten to move and throw a stink?
I did, but obviously, it wasn't really going to follow
there you
through.
go.
That's good. So, good for you. For trying.
Yeah, I think they called the bluff pretty early on. But
take the sink with you when you leave.
Yeah. I think they just know that everyone's going to do it, right? Just pay because everyone's in the same boat right now. But I mean, there are indications. So I think Goldman won one of the few places a couple of weeks ago that said, okay, the Fed are going to be done for May or June onwards. So there's like 2 periods in this year. I think it's pretty much every year, but there's 2 months where there's no FOMC meeting. So that's obviously April, we haven't had anything, and then there's one again in like August. So you have these periods where it's basically nothing but data to fill the time until the next meeting, which, we've had quite a bit of data come through now. And the pieces that we're not going to see on the real estate side is that there has been some drawdowns in rent and house prices, but that really doesn't filter into the CPI numbers, or it lags quite a long time. So, I actually think the Fed will probably hike again, but then that's probably it for this year. I kind of agree with that sentiment.
How did risk assets perform on the back of that news? Were people a little bit shocked by the rate rise and the commentary around future rises or possibility of?
So, for ETH specifically, like we're up massively this week, and during but it's kind of weird because you had like minutes and the whole ETH upgrade, which we'll talk about, I guess, in a minute. But in general, the result of that, when I was watching Bloomberg, markets didn't react that well to the news off the bat of the minutes. But
yeah, I think it's somewhat interesting because, and we've been seeing this in crypto for the last couple cycles. It feels to me, I haven't run the numbers, so I can't definitively say this is the exact thing. But it feels to me that the crypto prices have been somewhat decoupling from the narrative for other risk assets. And I'm not sure if this just means that the market makers that were and the algorithmic firms that were basically enforcing those correlations are no longer as active because they don't have as much banking ability to move capital back and forth and efficiently do that. Or, it could actually just be that, crypto is kind of coming into its own as a, deflationary / sound money type of asset. And in this environment, it's becoming an attractive choice. But it does appear to me like there are a lot of tailwinds that are kind of pushing crypto in this cycle to be somewhat of a, uncorrelated asset to other risk assets. And it's an interesting trend. I won't pontificate exactly what it means at this point because I think it's still too early to tell. But I personally think that the Ethereum upgrade that came out this week is a massive tailwind that kind of puts us in a position where, to me, I think this is probably the incitement of, I think, one of the best stories for, an asset over the next 5 to 10 years in terms of Ethereum. We're overweight as a company at DeepQ, and we're also, I guess I'd say I'm personally overweight Ethereum. So I'm a little bit biased. So noted, this is not financial advice, nor am I explicitly talking my own book, but I'm kind of talking my own book. That being said, I think this is really, really, really fantastic. I think we should probably just jump in a little bit. I don't know, Matt, do you want to give a quick update in terms of what exactly this upgrade is and what it means to, I guess, the technology perspective of crypto?
Yeah, so for anyone that's not familiar, there's been the process of staking. So the merge happened last year, and you can basically stake your Ethereum. So if you own enough Ethereum, you can start a node and stake it, or you could stake it on a provider. So the main one was probably Kraken in the US, and they offered a service where you could basically just post your excess Ethereum into their node that they ran, and then you get paid rewards for being part of the consensus protocol, which is usually I think the Kraken rate was 4 to 7% range, something like that. Of course, Kraken got screwed by the SEC, so they had a settlement where they said they would stop offering that, but it still meant that people's funds were locked in that ETH 2.0 contract. And so why would they do that? Well, they went to a consensus protocol last year, but they didn't want people to just start withdrawing their money immediately. Like withdrawing, you want to have enough people deposit, have a stable system running, and then you allow people to start taking out and withdrawing funds. So that's kind of what the reason why there's been this lockout period. And that, as of Tuesday this week, on the 12th of April, has now changed. So there were two upgrades, affectionately known as Shapella, which is the merge of the Shanghai upgrade, which was part of the execution layer upgrade, and then the Capella upgrade, which was for the consensus layer. So the nodes have to be updated as well. And what that now meant is you can then go into a withdrawal queue. So it doesn't mean you immediately get your funds out, but you can at least be entered into a withdrawal queue, and that will be processed. And then eventually that queue will just go away to like 0 time buffer. But so there's a small rollout where you have to wait amount of time, and that will eventually go to like 0, and you can withdraw immediately, like you can on other chains. But yeah, so that was the big thing, and we've been like looking forward to this because it kind of paves the way now to like have people comfortably staking in and out, and adding consensus nodes as people see fit, without the fear of never being able to withdraw.
Yeah. Now, for complete transparency, I'm going to tell you that in 2020, I went just totally fucking all in on Ethereum, and I was right, but for the exact wrong reasons. Let me tell you why I was wrong. In 2020, I took a bunch of cash because we were in a 0 interest rate policy stake, and I was like, I'm fucking sitting here earning 0% on any of this stuff, and I'm pretty bullish on crypto, and I think that Ethereum 2.0 is due any day now, probably later on this summer. So like in February of like 2020, I got like my bonus, and I chucked some money into Ethereum. Less than I would like to, but more than my wife was comfortable with.
It's a good balance.
It tends to be a good way to invest.
I'm like, it's never enough, but I'm like, will my wife kill me? Like, no, but she'll be pissed off. I'm like, that's a good,
exactly. So she was totally pissed off at me for a little bit, and then was like, you know what, fuck it, like you're a big boy, you do what you gotta do. So anyway, and my thesis for putting money into Ethereum in February of 2020 was that like, and I'm earning no yield right now, so I may as well put it into Ethereum, and then I'll be making 5% staking yield tomorrow. And lo and behold, it's 2023, and we're finally talking about it. So the reason why I bring this story up, because I think it's actually notable that the Ethereum Foundation, up until recently, I would say, was not particularly known for hitting deadlines well. Like, this is something that's been years in the making.
Oh, yeah, I think they developed a reputation for being late.
So the fact that we have got this over the line, like, if you're a rational investor, you would never sit around and be like, oh yeah, I'm gonna bet a bunch of clients' money that if the Ethereum Foundation is going to hit its deadline and deliver on technology the way that it said it was going to. But now that we're actually there, to me, this says that this is sort of like the last little bit in place before people a large scale could comfortably say, okay, if I want to now, I can buy Ethereum, I can stake it. This opens up the avenue for some very interesting yield products in crypto that are based on effectively like a crypto risk-free rate. To be able to provide staking, and in my mind, a very, very, very interesting thing that comes with a lot more certainty now. And if we know anything about institutional investors, they crave certainty, or at least some reasonable expectation of delivery in time. So I don't know. To me, like, people that follow crypto are like, yeah, this is going to happen, it's fine. But like, the fact that we have this over the line, I think, is a massive thing in terms of opening up the door for further institutional investment in the space.
Yeah, I mean, like, to your point, I think a lot of people that are in venture or very growthy type of companies, we kind of have these like pie in the sky ideas. but to see actual execution come through, like that's really, it solidifies things a lot more, to your point.
Yeah. And so for me, I think like what this really does, if you think about it, is I actually think that the shift from Ethereum, proof of work, over to proof of stake, is in some ways like crypto's broadband moment. And you've heard me say this analogy before, but I'll reiterate it very quickly. It's like, you know, in the internet, when it came out and we were reliant on dial-up modems and 52 kilobaud per hour, sort of like, you know, like I'm going to download this picture or I'm going to download this MP3 and it's going to take me 3 hours. And, you know, when I come back tomorrow, I'll be able to listen to this Red Hot Chili Peppers song, right? Like
One song,
one song, but it's going to be great. It's going to be ground changing.
Yeah.
I'm going to get Weezer's Buddy Holly on my computer finally. So
all the college students listening are like, "What's Weezer?
what's a Weezer?
What's a Weezer?"
It's like, listen, no, dude, I was
Aging
around
yourself,
Napster, LimeWire, Morpheus, all that shit. And I distinctly remember sitting around like having a queue of like 3 or 4 songs. It's like, oh man, I cannot wait. I'm gonna be able to burn that girl that mixtape that I've been promising her for the last 3 weeks. On my CD, my rewritable CD-ROM.
I love it.
But like the point being is that now we're at a state where that's effectively where crypto is, right, at the moment. And you move over to proof of work, and then there are already blockchains that are doing proof of work, but you move over proof of work onto something at the scale of the Ethereum, and to me that basically is the equivalent of shifting from, you know, dial-up internet to broadband. And this opens up a massive world for DeFi to come in at scale. And if you think of like all the use cases that people, you know, have about crypto and all the statements of people, it's like, oh, crypto's 10 years in and you still haven't improved your utility. What I'm telling you is this is the utility of crypto. And now that we are here with a decentralized chain the size of like Ethereum at scale, at proof of work, and you know, people can stake and unstake with confidence, knowing that their money's not going to be locked up in perpetuity forever. I think you're really going to start to see things move at a different momentum now. I for one think that, you know, this is going to be sort of like a groundbreaking change in the momentum of crypto from a utility perspective. And open up the gates for a lot of really cool applications of crypto beyond that of just like speculating on the price of Bitcoin.
Yeah. Yeah. It's so funny. Like having conversations with friends are always like, what's the use case? Like, I don't see the use case. And it's like, what, you have to build the infrastructure out. I mean, these are people that aren't in the industry, right? They just being able to see it. You have to have the infrastructure in place to do that. So now it allows things to become commercial that weren't before.
Yeah, I mean, I think we've particularly been going down the DeFi rabbit hole as a company for a couple of reasons, and the first is I'm such a believer in DeFi, just from the economics perspective of being a business owner. And I think when people ask about, you know, why I'm so bullish on DeFi, I use the analogy of being an Uber driver. So let's say you decide to start your own, you know, private business as being an Uber driver, and you can go out and you can get a handful of rides per day. And Ethereum, like Uber is going to schedule a lot of those rides for you and take away from a lot of the hassle of having to do that. So that's fantastic, and you sign up. And then you find out they take a 30% cut of all your rides. They're fine, you know, they gotta get paid, whatever. They take a 30% cut. What would you do if you could find out that there were a similarly sized network, meaning you get the exact same number of rides per day, and it would come from a decentralized protocol that, you know, couldn't censor you, couldn't kick you off, couldn't withhold payment for whatever reason that it wanted to, And also, instead of taking 30%, it took 1%. Right? Like that changes the economics dramatically. And I think if you are in the market making game, or if you're a market participant in crypto, one of the beautiful things is, like, if you're looking at, this, let's just use a name for the sake of using a name. Coinbase and Uniswap do roughly the same volume, right? So if you had a choice, being a market maker on Coinbase, and go online, look at their publicly available information, and see how much you get charged even to make on Uniswap, right? You're paying several basis points to provide liquidity. And in DeFi, you can provide the same liquidity, take the same market risk, right? But you get paid. You get paid like 5 to 30 basis points per transaction to provide liquidity. It's like,
why would
I not?
Yeah.
Right? Like, the economics of that are so much better. And so from our perspective, it's like, it's better, more fair. A DeFi protocol could get hacked. I mean, that's definitely a risk. But Uniswap and SushiSwap, like, the more sort of, like, established names in that they've been around for quite some time. So as long as you stick to places where your smart contract risk is reasonably small, you're kind of sitting in a circumstance where it's like, all right, like, this is somewhat of a no-brainer for me, and I know I'm probably not going to get hacked on Uniswap. They do just as much volume as Coinbase, and I'm getting paid significantly more to provide the same liquidity.
Something too.
It's an interesting. Sorry, Rob. You
go ahead. I was going to say.
Okay.
I just want to do this the rest of the show. It's got to go.
No, wait. You talk.
No. Go on.
No, seriously. No, what I was just going to say is, like, to your point, I was like wondering. So obviously there are also insurance protocols too, where you can be insured against hacks, right? Like, it'd be kind of interesting to look at. Something I'll do maybe for the next show is to try to take a peek at how much it would cost to insure against hack. Like, to your point, like, you're getting paid, you're maybe taking some counterparty risk, but that can even be diversified away too. And my nose would tell me that you could still be able to eke out a better profit. That's all I was saying. Go ahead, man.
Yeah. No, I think the great thing about DeFi is, I think of it like financial Lego blocks, right? Mm-hmm. So it's all built on this protocol, and the majority of it lives in the Ethereum ecosystem. Mm-hmm. And it allows you to kind of mix and match various products. Now, they're in different levels of maturity, so it could very well be that one product is like, fantastic, easy way to go about doing it. And then the next one is just garbage, and you might get hacked and all that sort of stuff. So you really need to do your own research. But that being said, for some of the more established names, I would say your risk of getting hacked is reasonably small. If someone could have hacked Uniswap or SushiSwap or one of these bigger, providers, they would have done it already, because there's literally billions of dollars to make in doing so. So that being said, there's a number of reasons why you wouldn't want to immediately jump in, but from like a smart contract risk and all that sort of stuff, it's pretty well covered at this point, provided you stick to some of the more established names.
Yeah,
you've painted a very rosy picture of this. Like, AMMs, you get paid. That sounds great. Like, why would not everyone just do that then? What's the differences with it?
Great question. So let's actually talk about this, because I think this is super useful. And maybe to do that, let's take a quick step back and just cover very quickly what happens when you deal on a CeFi, or a centralized finance exchange, right? The way that a centralized finance exchange works is that you preload money onto a centralized exchange. And that centralized exchange should, in theory, keep your assets one-to-one. But as we saw in FTX, that might not always be the case. But let's assume you're working with like a well-governed, place, and they keep it one-to-one. And so like you just put money on the exchange, and they have a mechanism called a central limit order book. A central limit order book basically is just a market maker will make a price either on the buy or the sell side, right? So they're basically saying, I'm willing to buy at this amount, and I'm willing to sell at this amount. And think of this like some giant voting mechanism where you have a number of market participants who are in real time looking at the price, and they're putting in their bids, which is their willingness to buy, and their offer, or their willingness to sell. And they're saying, this is my price. And eventually you come to some equilibrium where that central limit order book gives you a true market price. So there will be some limit of what the price that people are willing to buy at, and some limit at the price that people are willing to sell at, and those will meet, and you will get some equilibrium price. And market makers will give liquidity as they need to across that spectrum. So some people are willing to give liquidity exactly at the current price, and some people want to rest a little bit further back in the order book. Maybe they were a bit more conservative, or maybe they're waiting for the right price, so they'll rest something like super down. So like if the current price is 100, they're like, I don't really love it at 100, but I'll put a limit order to buy at 90. And this is basically a way for people to be what's called capital efficient, right? There's no expectation as a market maker on a central limit order book for you to provide a price for every single point on the spectrum. So if the current price is 100, right, the price on the spectrum could be anywhere from 0 to positive infinity. You're not required as a market maker to provide buy price and sell prices. And you're not provided to provide prices from 100 all the way down to 0. You only have to put a price in at the place that you want to put your price in, which means if you have a view on the market, or if you have limited capital, or if you want to be efficient, maybe you think you'd rather buy than sell, and so you don't want to provide sell liquidity at the moment, right? This allows you to be fully capital efficient in the sense that you only have to put at risk the amount of money that you want to put at risk in the direction and at the price that you want to put it at risk for. So that is one of the nice things about a central limit order book. It gives you ultimate granularity as a market maker to decide exactly how much risk you want to put on and at what price you want to put it on. And you can look at the entirety of the order book and be like, all right, this is where I want to be. Version 1, go for it.
So a quick question, and you can feel free to answer this later after you finish your thought. So then this new version of Uniswap, where you can be more targeted in your pricing, that's just like, to me, that's not even automated market. That's basically like a CLOB then, right? Like how narrow can you get? Can you get like super, I mean, you can get so narrow in your pricing, it's basically.
Yes. So that's exactly, you've speed played through the point that I was going to make.
Okay, sorry.
No, which is fantastic. So the point is that, and I'll preface this, like V0 of automated market making was that you had to put in equal amounts of, let's say you're doing it in Ethereum and USDC. Mm-hmm. You had to put in equal amounts of Ethereum and equal amounts of USDC into a contract. And that contract basically spreads your market risk out from 0 to positive infinity. So you had to provide liquidity across every point of the curve. And when somebody came into a DeFi protocol to buy or sell, what happens is that every participant in the pool gets a pro rata share of the fees across every point in the pool. So it's almost like communism for market makers, where it's like everyone's taking the same risk. It's all spread out. The only difference is how much money you put in, and then we just pro rata allocate across it. And, there's some concept of, market risk that we're going to call impermanent loss. And I'll get into why I think that's actually the shittiest name in the world for impermanent loss. And we're also going to just give, fees across the board. So the only variable that you can control is how much money you put in. And in doing so, you'd make, I don't know, like 5 to 15% in the, bellwether names, and maybe slightly more for some of the, smaller names. And that's all well and good. But if you're a market maker, you don't really get into the business because you want to earn like 10%. Right? Like, I can think of easier ways to make 10% on my money, inclusive of, putting it into real estate or high yield bonds or something along those lines, right? So if I'm taking smart contract risk, it's not a very capital efficient thing to do. So in subsequent versions of Uniswap, they changed the protocol to make it a little bit easier. And now they have what's called concentrated liquidity. And just like you said, Robert, across the curve of possible prices for DeFi from 0 to positive infinity, you can actually select a range in which you want to provide liquidity. So let's say, for example, the current price of Ethereum is, for round numbers, we'll say it's 2,000. Let's say I don't want to give a price from 0 to positive infinity and earn 5%. Maybe I wanted to earn more, right? But I'm willing to take more market risk. Now I can trade off between market risk and fees that I earn by basically saying what I would prefer to do is make a price between 1,900 and 2,100, and I'm going to put money in. So let's say I have market maker A and market maker B. Market maker A puts in $1 million into this pool, so half Ethereum, half USDC, and spreads out the range of prices in which they want to make markets from $0 to positive infinity. And when someone buys, they get a smaller pool because their risk is spread out across that larger surface area. And so maybe they make like 5 to 10% a year. And then someone else comes in and says, all right, I want to make markets over 1950 to 20,000 or 2,500. Great. They do that. And now, as long as the price is in between their tighter range, they earn a greater percentage of fees because they're putting more capital at risk in that bucket. But they're taking more market risk, right? Because they're exposing themselves to market moves in that tiny range rather than spread it out over the entire surface of the price universe. So now, as a market maker in these concentrated liquidity pools, you actually have a trade-off. You can say, how much impermanent loss or market risk do I want to take? I can take a little amounts of market risk and just earn fees and spread out my market risk over the entire surface of the price curve from positive infinity down to 0, or I can make a much more concentrated bet. I therefore earn a bigger share of the fees, but now I'm more at risk based on market movements, meaning if I put in $100 of Ethereum and $100 worth of $100 of USDC, if the price goes up, right, I could get wiped out and I could basically, as the price of Ethereum goes up, I'm selling all of my Ethereum and I'm all in cash, which means I've gotten rid of all my Ethereum at 2,500, and if it goes up to 4,000, I'm in cash right now. Versus if I spread the price out over the entire curve, if the price goes up, I've sold out a little bit in my position, but I still have, maybe I'm like, instead of being 50-50 cash and Ethereum, I'm like 45% Ethereum and 55% cash. So I still have my Ethereum as the price goes up. I'm not fully liquidating it, but I've also earned some fees. So that's sort of the trade-off that you have when you do concentrated liquidity pools. But that's great because as a market maker, if your job is to take market risk and you understand the risk, that might not be something that you'd want to just like put your money into and set it and forget it and come back in like 3 weeks' time and see how it's going. But if your job is to do that every day, this now becomes very compelling because you can take exactly the amount of market risk that you want and you can earn a compelling amount of fees to compensate you for that market risk. So to me, this is a fantastic thing because it gives you that ability to be capital efficient if you want to be capital efficient, and or spread out your risk across the entire surface of price universe if you want to be a bit more risk averse and just sort of like collect some benign fees in the background.
It opens up some interesting trading strategies as well. Like you mentioned, getting wiped out or converted fully into USDC cash. But actually, maybe wanting to get out, maybe wanting to close a risk position. And so now you can kind of earn fees on the way out and close in your position at hopefully is a level that you kind of wanted, which would be like a weighted average cost into your exit point. So there's some interesting like use cases just for exiting or getting into risk as well as just making. And so this was a point I was going to make earlier, is that as a product, it's actually pretty interesting because it's not like the CeFi market, which is spot, where it's purely you buy and sell. Like with this strategy, you're kind of setting boundaries, and it acts very much like a short straddle strategy. So this is an option product where you sell a call, sell a put, and if this is your zero line, you have this little triangle above it, that's where you make money in that straddle strategy. And that's kind of what happens in this Uniswap V3 version as well. There's a period where you make money between your boundaries. Outside of that, you've been fully converted and you start making money. So it actually has some analogies to like a short vol strategy, which is kind of interesting. There's some interesting dynamics there as well. And so there's obviously certain things you don't want to happen, like a really fast rallying market or a market that sells off means you're likely to hit your boundaries faster. So that wouldn't be good for you. Like a jump process would not be good for you. Something that immediately jumped out very close to your boundaries would not be good. So you kind of want something that wiggles around within your bounds quite nicely and slowly. That's kind of the optimum style of strategy in that, if you want to maximize fees, that is.
So I get like another question for me then, because we've talked about like what is low latency and how does that affect, like how does that differ between traditional financial markets and on chain? Talked a lot about how on within the crypto universe things are done on the cloud, so things are a little bit slower, so a little more democratic. In that similar mindset, when you have these bands, like I think of like high frequency trader market makers like being like laser focused on like price points where they're wanting to pull in and like put in positions and not. With these bands, it's a little bit, to me, like slower. You can kind of have like a wider remit, right? So you don't really need to be like pulling in and out of the market as much, I would imagine.
Yeah, yes and no.
Okay.
So this is where it kind of gets interesting. If DeFi were the only thing that you did, right, then you're correct. At least for now. I think as the technology gets better, you can do so much interesting things. So like a case in point. Let's start with a world where DeFi is the only thing that you do, and you're using DeFi to enter into positions. If you're doing it on the Ethereum blockchain, you're talking, like several seconds to a minute before the block actually gets finalized and you get into your position. It's also reasonably expensive, so gas fees can be several bucks, which means if you place an order and let it accumulate fees all day long, probably not that big of a deal, right? If you place orders at the rate that a high frequency trader does, you could get wiped out pretty quickly. So that's not a smart thing.
Yeah.
Uniswap actually has a fantastic feature where they actually they have pools that exist on Ethereum. They also have pools that exist on Polygon. And those are significantly faster. Not quite HFT rates, but they're significantly faster.
And cheaper.
And much cheaper. So we're talking, instead of several dollars, we're talking several cents. Which means that you can approach, maybe not HFT ranges, but you can approach medium frequency strategies. When I say medium frequency, that's sort of common parlance for seconds to minutes type of strategies. So that's doable. The other element of where this can become interesting is, as Matt said, you can almost think of DeFi as sort of like allowing you to create option structures where you're selling volatility. And those are great for generating income because the nature of selling volatility is basically you sell volatility for some out-of-the-money event, right? In fact, it's the exact same structure that like insurance companies have, right? Insurance companies are super happy to collect your premium on the off chance that your house might burn down or that you get into a car accident or something along those lines, right? Like, so their entire business is trying to attach a probability for some obscure event that might happen and collect enough money such that as that happens, they get paid for it. And what makes DeFi extremely interesting is that the profiles of dealing in DeFi very much look like an option strategy where you get paid so long as the price stays within some certain range, and you really get wiped out when the price moves dramatically. But you hope that if you do it over a very long period of time, you make enough money in the good times or in the not very volatile times to get compensated for the one out of every some handful of times where you get wiped out. So that's element one. Not high frequency, but still interesting, and the math is nice and complex and actually reasonably well understood because it mirrors so closely the type of payoff structures that you'd find in traditional finance with options. Now, where it can also be interesting is if you layer in DeFi with CeFi, in the sense that there are interesting dynamics between DeFi pricing and CeFi pricing. They have a known relationship between each other. And if you, for example, if when you are doing options trading, people will often delta hedge, right? Meaning they want to expose themselves to a particular aspect of that risk of an options payoff. And you can, layering in like the spot market plus options, you can actually mitigate maybe your price risk and only have, risk to volatility. Right? So if you're a high frequency market maker and you actually can hedge better, faster, or more intuitively, then that gives you an edge in terms of like decomposing the risk of your automated market making concentrated liquidity profile, and gives you the ability to hedge that in a more intelligent ways. So I think the idea being is that DeFi with concentrated liquidity actually gives you this really cool way to not only take outright positions, but also take positions and then layer that in with other financial products to give yourself a portfolio that gives you the risk and return profile that you really want, which is kind of cool.
Yeah, and I think I was reading that Deribit have just released a new futures contract. I mean, we won't trade it because they're not US regulated, but a new futures contract like DVOL, so you can literally, the CeFi equivalent would be the VIX index or the volatility index that trades on CME or CBOE, I forget.
Yeah.
CME. But yeah, anyway, so the volatility of the S&P, you now have the volatility index of the Bitcoin or Ethereum or something. So even if you're short gamma, you can kind of short vol, you can kind of buy a lot of that. To hedge that as well, which is interesting. So there's cool stuff happening.
It's awesome, and we're gonna have a guest on next week too. Let me dig into a little bit more.
Yes.
Fun techie stuff, right? Who do we have on today? I know you guys mentioned it before, so I forgot to write it down.
Our good friend Nicholas.
Oh, that's right, Nicholas.
Henke is going to be on. He works with us by way of Germany. He's a recent PhD grad who's done a lot of really interesting work in DeFi, first as a hobbyist and then, through his own sort of like own work. And he's been really key to sort of helping us understand how to think about DeFi and how to decompose DeFi into a way which maps back to the way we think about things in traditional finance. So I think that the key here is that if you're a traditional finance background person, you somewhat have an edge because a lot of these structures are the exact same structures that you studied in school or that you traded for a number of years, and it's really cool. The difficulty, though, is sort of taking the new language and the new thought processes and new technology around this and translating that into terms which can then be layered with traditional finance products. So I think we actually kind of have a really cool agenda put out for the next week's episode. This was very much sort of meant to be a primer in terms of like why we think DeFi is really cool and what's really interesting for us in the space, and quite frankly why we're going all in on DeFi. And then next week we're really going to talk about sort of the elegance of the math behind how you can get DeFi to mirror concepts in traditional finance, and how concentrated liquidity actually gets you extremely close, as you stated intuitively, Robert, to making it like you would on a central limit order book. And then also we're going to go a bit into the challenges from a data perspective and from a technology perspective in terms of marrying DeFi infrastructure with high frequency trading infrastructure on CeFi. Because as one would imagine, it's not trivial. And even a lot of the technology providers out there are giving a very solid effort, but not quite to the standard that we think is important in order to properly trade and model a DeFi protocol. So I think there's some really cool shit that we have built internally, and Nicholas has been fantastic in getting us over the line on that. And I'm pretty excited to give a bit more color on that, because I think we've been working on this for several months now, and we're just to the point where we're ready to go live. And so far, so good in terms of interesting things that we've seen coming out of the project. I don't know, Matt, do you want to go any more depth, or have I covered it adequately?
Covered very adequately.
Perfect.
Any more, we'll have to do a gag order. Got to keep some secrets and some.
Yeah, I mean that's probably also just like Carlos.
Yeah, shut up! Do not give away our secret sauce.
I mean, for reference, it's going to be as usual pretty high level, but I think it's just interesting to see some of the stuff that can be done, and we'll happily talk about that.
As a precursor, I'd say one interesting thing that kind of I had to really change my perspective on is this concept of all of the trades in the history, like all of the data from the history of this thing is publicly available. And you can just download it at any point in time. and we're CeFi nerds. We come from like a traditional finance world where it's like data is oil, and you get like half of the stuff that you do is just built around like, all right, how do I get data? How do I store all this data? How do I hoard this data? How do I make sure no one ever finds my precious and takes the data from me? And now we're like, hold on, you're just telling me like anyone could just download this fucking data? Like it's just there for everyone? Like why?
Yeah.
Don't they realize they can make so much more money if they just sold the data? So it changes the way you architect your system in some ways. So I think it's a fun thing to discuss, and I can't wait to go into the details next week.
Awesome.
Or maybe not the details, but at least discuss a little bit of the. If you want more, you'll have to take me and Matt and Nicholas out for dinner.
You have to buy us dinner first.
Yes.
Love it, boys. Thank you so much. It was fantastic. This episode was great. I learned a lot. Appreciate it.
Cheers, guys.
See ya.
Peace.
Bye.